Your dividend paid out this morning. $200, free money the stock paid you just for owning it. Now go look at what that stock is worth. The stock dropped by about $200 at the same time. That's not coincidence, and it's not the market moving. It sent you $200 of your own money and took $200 off the value of what you already owned. Money moved from one of your pockets to the other, and the tax man took a cut on the way. You are exactly where you started, except now you owe tax on it. That's lie number 1. There are 12 more, and every single one has an author who gets paid when you believe it. Here's the mechanism, because once you see it, you can't unsee it. You own 400 shares at $50 each, $20,000. The company declares a 50-cent dividend. On the morning it goes ex-dividend, the exchange marks the opening price down by that 50 cents. Not because anyone sold, because the company just handed away cash and is worth exactly that much less than it was the night before. Your shares are now worth $19,800 plus $200 in cash. $20,000. Identical. Now the part that costs you, that $200 is taxable in a regular brokerage account. At the 15% qualified rate, $30 goes to the government. The transaction that created nothing left you $30 poorer. Inside a retirement account, there's no tax event, and that matters, but most people building dividend portfolios are doing it in taxable accounts because the whole appeal is a spendable cash now. None of this makes dividend stocks bad. But a dividend is not a return. It's a withdrawal made for you on a schedule you don't control with a tax bill attached. The yield on the screen is not income falling from the sky. It's your own capital handed back in smaller pieces. And if a company handing you your own money can feel like a gift, wait until you see what happens when somebody sells you a policy. Number 2 gets sold at kitchen tables. Whole life insurance is an investment. Your premium buys coverage, and the extra builds cash value inside the policy. Real money. Yours. Growing. Here's the part that doesn't get said out loud. On a traditional whole life policy, when you die, your family receives the death benefit. The insurance company keeps the cash value. You funded both sides of that ledger for 30 years, and your family collects one of them. Some policies offer riders that pay both, and those riders cost more, which tells you exactly what the standard arrangement is worth to the insurer. Now run it. A 35-year-old man, $500,000 in coverage. Whole life runs about $5,400 a year. Level term, about $420. Buy the term, invest the $4,980 difference at 7%. And after 30 years, you have $506,288. The policy's cash value on a typical illustration is around $250,000. You gave up $256,000 for the privilege, and roughly the entire first year of premiums you paid never entered the policy at all. It went to the person who recommended it. That's not an accusation. It's how the product is compensated, and it's why it gets recommended. Which brings me to another thing people celebrate that they shouldn't. Number 3 arrives every April, and people celebrate it. A tax refund is a windfall. It isn't. It's a refund. The clue is in the word. You overpaid, and they're giving it back. The average refund this year came to $3,275. Spread across the year, that's $272.92 a month that you earned, never saw. And that sat with the government earning you nothing. People usually make this point by talking about lost interest. Lost interest is small, a few dozen dollars. That's not where the damage is. The damage is that most people over withholding are also carrying a balance. Right now, the average rate on credit card accounts that carry a balance is 22.15% according to the Federal Reserve. So picture the same person, $272 a month going to the government at 0%, while a card balance compounds at 22%. Money you could have applied to that debt the moment you earned it, sitting somewhere else instead. That costs $332.48 a year. Over 10 years, $3,324.81. Gone. So you could feel good in April. Nobody engineered this one, but there's an entire industry that markets the refund and never mentions the bill, and there's a reason every ad in February is about how big yours will be. Speaking of things that are marketed as free, Number 4 is printed on every windshield on the lot. 0% financing is free money. No interest. Why would anyone pay cash? Because you're paying for it, you just can't see where. Take a $38,000 car, 0% over 60 months. Now try paying cash and watch the price move. A $2,500 discount appears because the dealer would rather have the money today. Take the financing and you forfeit it. Run the math on that forfeited discount, and the real cost of that 0% loan is 2.71%. Not a ripoff. Not free either. Nothing on that lot is. But the deeper problem isn't the rate. It's the term. $42,000, 7.2%, 84 months. $638 a month, which is the number the finance office is optimizing for. At month 24, you owe $32,067 on a car worth $28,560. $3,507 underwater. You don't break even until month 48, 4 years into a 7-year loan before you own a single dollar of that car. And most people don't make it that far. They trade at year 3, the dealer rolls the negative equity into the next loan, and now they're financing a car they no longer own on top of the one they just bought. Do that twice and you're paying for 3 vehicles and driving 1. The car isn't the problem, the term is. A longer loan makes an unaffordable payment look affordable, which is the same trick people use to justify buying a house. Number 5, you've heard from your own parents. Renting is throwing money away. Your agent says it too, and everyone who bought before 2020. Here's what nobody says. Interest is also throwing money away. So is property tax, maintenance, insurance, and every dollar of commission when you sell. Take a $420,000 house, 20% down at 6.65%. Year 1, you pay $22,344 in mortgage interest, $4,620 in property tax, about $4,200 in maintenance, $1,800 in insurance. That's $32,964, $2,747 a month. None of it builds equity. None of it comes back. It is exactly as gone as rent. Add 9% in round-trip transaction costs, and that's another $37,800. So the real comparison was never renting versus owning. It's what you burn versus what they burn. If your rent is below $2,747 a month, you're the one with money left over, and what you do with that difference decides everything. Above it, buying probably wins. There is no universal answer. Anyone who tells you renting is always throwing money away is selling something, and anyone who says buying is always a trap is selling something else. But at least a mortgage is honest about what it measures. Number 6 is a 3-digit number you check like a report card. Your credit score measures how good you are with money. It has never measured that. A credit score estimates one thing, which is how likely you are to repay borrowed money. That's a prediction, and it's made for lenders. Lenders are the customer, you're the subject, which explains the behavior that seems insane. Pay off your mortgage and your score can drop. Go debt-free for a few years and your file can go dormant. You can have $2 million invested, no debt, and no score at all, while somebody with 4 cards and a car loan sits at 780. The system isn't broken. It's answering a question about lending risk, and if you've never borrowed, it has nothing to say. This is also where the most repeated piece of bad advice in personal finance comes from. Carry a small balance, it builds your credit. It does not. No scoring model rewards you for paying interest. Not one. What matters is that the account is active and reported, so use the card and pay it in full. That's the whole thing. Every dollar of interest beyond that is a donation. A high score is worth having. It's worth real money on a mortgage. Just know what you're optimizing. You're not proving you're responsible, you're proving you're profitable to lend to. Now, 12 of the 13 things on this list have somebody behind them. Here's the one that doesn't. Number 7 is the only one on this list nobody profits from. A raise can push you into a higher bracket and leave you taking home less. Nobody profits from this one. No industry markets it. No salesman repeats it. It survives because it's comforting. It hands people a reason not to chase the promotion, and that's a reason a lot of us want. It's also false, and the arithmetic takes 10 seconds. Tax brackets are marginal. The higher rate applies only to the dollars above the threshold, never the ones below. Under this year's brackets, a single filer earning $119,000 pays $17,350 in federal income tax. Take a $5,000 raise to $124,000, which pushes you into the 24% bracket, and the tax goes to $18,494. So you crossed a bracket and you kept $3,856 of the $5,000. Your effective rate moved from 14.58% to 14.91%, a third of a percentage point. There has never been a raise in the history of the American tax code that left someone with less money. The structure makes it impossible. Take the raise. Then be careful where you put it. Number 8 feels like the responsible choice. Cash in a savings account is safe. No risk. FDIC insured. You can't lose it. You can, and most people are, right now. The FDIC national average savings rate is 0.38%. The best FDIC insured accounts available today pay around 4.15%. Same insurance. Same government backing. Same instant access. 11 times the yield. Put $25,000 in each and wait 10 years. The national average account grows to $25,966. $966 of interest over a decade. The high-yield account reaches $37,543. The default account cost you $11,576, and you took no extra risk to avoid it. Now adjust for inflation at a long-run 3%. That $25,000 in the average account is worth $19,321 in today's money. You lost 22.7% of your purchasing power while watching a balance that only went up. This is the cleanest business model in banking. Your deposit funds their lending, and the gap between what they earn and the 0.38 they pay you is the product. Legal, disclosed, and it works because moving money takes 20 minutes and almost nobody does it. Some people, having noticed this, decide the answer is to get out of the system entirely. Number 9 runs on late-night television. Gold protects